Okay, there you go. Thank you. I'm Dr. Ramakrishnan. I'm a radiologist in Virginia. I'm a little bit of a senior citizen compared with the registrants. Thank you for all registering. And I'm one of the co-founders of SEEEDS. Prasad will just give a very brief mention about what we do in SEEEDS in the middle of this presentation. I will introduce the panel consisting of Mr. Ram Kaluri, Mr. Sripat Pandey, and Ms. Ranika Sethi. They all out of an outfit known as Global Wealth Management out of Kingsport, Kingston, New Jersey. And first of all, our presenter, Ram Kaluri, he is the founder of Global Wealth Management and chairman. And he is a CFP and a CPA in practicing in finance and investment field from 1979, along with my practice at the same time. So I know him from that time. And Ram is a experienced greatly. He started working at CBS as a financial analyst, then went to Merrill Lynch as a financial analyst and investment manager. Then he started his own company, Global Wealth Management. I know him from those days of 1980. And it has grown to a huge organization now. And next would be Sripat Pandey. He's a Chief Investment Officer of Global Wealth Management. He has more than 20 years experience in securities industry, and he is an IIT Kanpur graduate, and then management in IIM Bangalore. And he came to be the president of ICICI Securities before joining Global Wealth Management. And I know him for many years. And Ranika Sethi is a relation manager at Global Wealth Management. She herself has personal experience operating business in Princeton, New Jersey. She's in the board of Princeton Education Foundation, and herself quite experienced in the finance field. So I turn over to these three people for this presentation, and I appreciate them giving their Saturday to this endeavor. This is not to sell anything. It is not to sell any products, and it is not to sell seeds to the participants. Of course, we would love your interest in see what SEEEDS does. And then if you wish to join us, we'll be glad to. Thank you. Thanks, Ram.
Ranika, you're going to change the slides for me? Or who is going to change the slides?
I'm going to change.
Good. Okay. Let's go to the next slide then. Okay, great. Earlier, Ram was saying that we were working with each other since 1980. What is interesting is the financial planning field itself in the United States was at the time in a nascent stage. The designation certified financial planner did not even exist in 1981-82. I was one of the first ones to get this certification in those days. And right out of the business school, I was very interested in strategic. In the CBS Corporation, I used to do a lot of strategic planning work for them. And I wondered whoever does it, strategic planning for individuals, navigating all the situations. Those were the days inflation was raging at 12%. And that was just the time that Paul Volcker, chairman of the Federal Reserve, came. And the interest rates rose from 6 to 22% in a matter of one year or so. What we're trying to give you today is our 4 decades of experience. And I'm happy to say that Dr. Ramakrishnan, has walked with me through this entire 40 years together. And we were good friends. He is an astute investor. Many times, not only we try to attempt to advise him, but we seek his input and guidance. And what do you think? That's how the partnership was all these years. And by the grace of God, I think we did okay. I mean, for him as well as to the other clients. So what we're trying to accomplish today is to give you exactly what is financial independence. How does one go about reaching that goal? And so this is a distilled version. This field is huge. There's so many topics that we can discuss. So today is an introductory session. And in the future sessions, we'll go a little bit more deeper. Let's go to the next slide. Yeah, we are going to address three issues basically. What exactly is financial security or independence? What do we mean by that? And the other thing is that I have put together a questionnaire called the 10 questions for financial independence. This is a questionnaire that you should print, or Prasad probably will send it to you later on. You should actually fill this questionnaire every year. Pick a date of, New Year's Day or birthdays or something like that. Don't do it on birthday. Probably you and your husband should spend time, our wife should spend some time going out and not looking into these kinds of things, but at least pick a date to fill this questionnaire. And then I'm also talking about steps to actually, what are the nuts and bolts that you need to do to achieve these goals? Okay, so those are the outlines, and then we'll open up for questions and answers. Prasad, let's go. This is in a, you can actually write it on a postcard. What exactly is financial security in life? No, the previous one. Having a roof over your head, debt-free, paid in full, no mortgage. That's a tall order. Having a reliable income stream for the rest of your life. No questions asked. Wanting to work is different from having to work. This is something that even in retirement, you may want to work, but you should not have to work so that you can maintain your lifestyle. So you have to have a reliable income stream to enjoy for the rest of your life. Of course, I already mentioned to you that becoming debt-free at the age of 60, typically young people buy a home and take a mortgage. Is a very constructive usage of leverage. And then they pay it off by the time their 60th birthday comes. There are other things that are also equally important. Children's education. In this country, children's education became a huge expensive ticket in the last 30, 40 years. Back in the days when my wife went to Columbia University engineering degree, the tuition for the whole year was $6,000. Now today, the same $6,000 is become $60,000, 10x. So if an undergraduate student has to go to college for 4 years, we're now talking about almost $200,000. If you have 2 kids, imagine the cost of doing those situations. So
now it is $70,000.
I stand corrected. So and so this is another huge big ticket item. And then you have to be able to maintain your lifestyle and make this financial system work for you in a smooth way. It should not be a chore. It should be something that it should be working for you very, very well. Financial security, financial independence really means even in the old age, when you are retired and you should be able to maintain your style of life without having to depend upon anybody. One thing, again, I'm going to make some comments because we've seen the whole life cycle from the beginning to the end. We used to have this illusion that somehow children will take care of you. No, those days are gone. So today, not that they have to support you financially, but they will actually at least be a part of you and manage your financial affairs and all that. Even that is becoming a challenge. So what is the bottom line for this is become financially astute, become informed consumer of financial services, and do very well for yourself. That is the encapsulated version of financial security. Let's go to the next slide. Yeah, there you go. These are the 10 items I mentioned to you: family income, living expenses, debt management, college expense, and all that. That is the questions that I'm mentioning to you in the 10 questions, the questionnaire that I was talking about. You should be asking yourself, what's the family income? What are our living expenses? Are we meeting our living expenses through our income? Are we spending more than what we're making? Or are we spending less money than what we're making? Debt management, how are we doing? Are we paying off our credit cards on time? Are we paying a mortgage on time? Or are we spending so much money on our credit cards now we're accumulating balances on the credit cards? College expenses, I just mentioned already that you're talking about state colleges, not even private schools. These days are costing 50, 60, 70, so $50,000, $60,000 is a reasonable number. Private schools, there are some schools in the Northeast, they're talking about $80,000. The investment management and savings is it's really not a rocket science. It's a hard, cold discipline. Remember this one phrase, if nothing else you remember from this is the time compounding. The time compounding is magic. If you were to earn measly, modest 7% a year, your money doubles every 10 years. Typically, a young person comes to the workforce, by the time they get their education done, and then they're married and they have a whole small family. The real earnings start somewhere about age 30. And it typically goes to age 65 or so. 65, take out another past 65, who knows? The 35 years, it's like, imagine yourself like an NBA player. These 35 years is the time either you use it or lose it. And in this period of time, if you compound your savings, invested wisely and compounded, it really gives you a dramatic leg up on the financial independence. If you miss one compounding, remember the 35 years, you really have every 10 years. So there are really 3.5 cycles of compounding. If you miss one cycle, one compounding, your end wealth is not reduced by 10% or 15%. No. It is cut in half. That is the magic of compounding. See, back in the, so this is actually compound interest, I believe, is an invention of some Indian mathematician, back in those days. So this is something very important. We'll be talking about this in our investments. Retirement income is basically packaging your savings, your Social Security, and your retirement distributions and everything else. This is again a packaging for retirement. Risk management is a safety net under the family. If, God forbid, something happens, you're married and you have a small child and you have a dependent family, life insurance basically is a safety net. What we're advocating is term life insurance so that you're not leaving your family to expose. Similarly, disability insurance and some of those things. When somebody says, I want to talk about insurance, don't shy away. Insurance plays an important role in your life. We don't sell insurance, but still we advocate that you should have appropriate insurance coverages at the right time in your life. And this is the last one, is my favorite, is wills. Holy cow. If I can tell you how many people I have come across in my life who said they don't have a will, you'll be shocked. Even in their 40s, 50s, 60s, they don't have a proper will. Very, very important, particularly the moment you have a small child, the wills are very, very important. I will get into some of these things in terms of when we talk about questions and answers. Emergency planning. Many times, A lot of people don't know if something happens to the earner of the family, the husband or the wife or somebody else, something happens to them, they're scrambling, where is what? How do we, they have no idea. In fact, I know a situation, one of my family members, gentleman is a physician, he passed away and a lot of his information he was holding on in his cell phone. And you know what happened is that they don't know how to unlock cell phone. Apple will not even, under no circumstances, they would open the cell phone. This lady, poor lady, was up the creek because she doesn't know how to open the cell phone. So this is emergency planning, just like emergency medicine has become in the recent times, a huge topic unto itself. And that's something also will ask a question. And finally, get to know your family advisors. Who are they? Who is my accountant? Who is my attorney? Who is my financial advisor? So on and so forth. Because these people can make your life easier when you need them. All right, now, next. This is what I was talking about. Now we're talking nuts and bolts. Hold a family financial review every year. Who in any family, it's somehow division, labor, whatever it is, one person takes the lead in the financial affairs, the other person generally participates and depends upon the thing. That is my experience. I'm not being a sexist, but this is how it happens. In some families, it is a husband. In some families, it is a wife. And I've seen them, the other person is not as well informed in about this family's financial affairs regularly. So what should you do? Every year you should hold a family financial review. If you do it once in 6 months is wonderful, but at least once a year. Ask a lot of questions to the family, the person who is managing the finances, using this 10 questionnaire. Ask the question, if something happens to you, where do we get our income from? Who do I call to get the monthly check I need? Ask these simple questions. That questionnaire we mentioned to you, that's very important. Family review binder. In other words, make sure you actually make a binder of all your financial statements, your tax returns, your insurance policies and everything else. Don't send your family on a wild goose chase should something were to happen untoward in the family. I come across this all the time. The family's financial affairs, nobody knows. Something happens, that is the time they're scrambling. It need not be. It need not be. So do that so that as a part of an emergency. Also encourage the spouse who is following to make some notes, ask questions. I do this with my wife, and she, every time I meet her, she says, you explained to me, but I don't remember. What is it again? But these are all very knowledgeable, experienced people. I'm not belittling anybody, but that's how it is. Invite an adult family, your son, your daughter, or maybe your brother, your cousin, whoever, somebody who should know at a high level where is what and everything else, because sometimes this is what they call it, a friend of the family. Usually they are even mentioned in the will, they're a friend of the family, but invite somebody. Now, 5-10 years ago, I told my wife one day cold, I said, listen, going tomorrow onwards, I'm not going to write a check in the family's bills. You take over, you write the checks, you manage the finances, because it's important for me to train her should something happen to me. So this is the kind of a training. It's like, take the analogy of tennis. Today, the top 100 players, 96% of them play tennis with two hands, double hand. Backhands are usually hit with two hands. Same thing here. Involve them, train them, ask them to participate in your family's financial affairs. Let the spouse talk to your accountant, your financial advisor, invite them to financial reviews. I come across the situations, again, I wonder sometimes why is that the spouse is not participating as much as they should be participating. I'm making these comments out of my experience of 40 years, not to point fingers at anybody. Finances are there for you to enjoy. You are living in the greatest country in the world, bar none. And the capital markets of the United States are extraordinary. What it can do for you in this country, what these capital markets can do for you, if you can make inflation plus 5% and compound that money, we're talking real home runs. Learn how to do that. And next, I think we're going to go to questions and answers. That's in encapsulated version. We can get into a lot more discussions and questions. I'm happy to take questions from anybody at this time.
Yeah, so before we go to the questions, let's just quickly, let me give a quick introduction about SEEEDS, like less than 5 minutes, and then we will go to the questions. Already we received some questions from the attendees via email, and then we also have a set of questions. In the meantime, attendees, please, you can raise your hand or you can put it in the chat, your in the questions as well in Q&A. We will address it as well. Okay. Okay. So SEEEDS, current status position of SEEEDS. I will just. I am Dr. KVN Prasad. I'm co-founder and president of SEEEDS. Okay. So this is our team. Dr. Ramakrishnan, our mentor, who is also on the call, in today's call. Myself, Dr. Nivedita, she is a vice president, and she is from UK. Mr. Jay Kumar, Mohan Kumar, they are all in US, in West Coast. Mr. Raja Ram from India, he is a treasurer. And we have our India team, Mr. Logomurthy Saravanan, Mr. Murali Krishnan, and Arumugam. So they are our again pillars in India who help us, who run the show. There. So we started our journey in 2016 with 2 students, and then we progressed. The numbers you can see: 39, 75, 125, 248, and currently we are at 400 students. We are supporting 400 students currently. So and all these 400 students comprise from different branches. So okay, sorry. Yeah, so this is the distribution of our students. That is arts, BA, or any other specializations. That is 15 students, and BCom in 111, engineering 62, medical. That is MBBS, it is medical, 25, paramedical, nursing, and other paramedical courses, 75, polytechnic, diploma, or any other diploma courses, 14, BSc science students, 98, and we have 3 law students this year. So this makes us 401. That is a total aggregated students. And we have registered in US, I mean in UK as well now. So any donors in UK as well, they can donate, and they also will get the tax benefit. And since we started in 2016, already some of our students have graduated, and they are all now placed in these organizations. Either they have started working this year in 2021, and some of the students who have they got campus placements, and they will be starting from after they graduate in 2022. Okay, so this is just a quick summary of SEEEDS, or what we are doing. So basically, we identify below poverty line children in India and provide the college scholarship. So our criteria is not just students have scored like a 90-95%. We also want them. They are like below poverty line, really struggling students who cannot afford even to send a or like a degree, BCom, BSc, like 5,000 rupees course fee. That is that those type of students also we have, and out of these 400 students, they can't afford that much money. Also, they are so poor, but their ambitions are very high. They want to achieve big in their career. At the same time, they have scored good academic percentages. So how we do is, so we basically send a volunteer to their house to ensure that they are what they are claiming as a poverty level, economic status, it is true, right? So we do the thorough testing and thorough verification. After that only we select. If you look at it, last year, 1,261 applications we received. We shortlisted 448 for the house verification. Finally, we selected only 152. Like it's like less than 1:3, 1:4 ratio approximately, right? So that's the level of scrutiny we do, and we want to make sure that every dollar reaches the deserving students. So our expenses are almost nil. All are volunteer based only. So every dollar goes to the student. So with this, I will stop here, and then we can go to the questions. So the top 10 questions which Mr. Ram shared in the presentation, all right, that PDF file I will email to everybody registered who have attended and who missed to attend this webinar, right? And Mr. Ram, like, should we go through the first questions, or should we go through all the questions?
No, feel free, whatever, fire away.
Yeah, right. Okay. So one of the question it came, right? So your advice on someone in in their 30s for financial independence. What is the advice you are giving for a person in 30s of financial independence? That's the question.
I think this is my favorite phrase. People may or may not like it. Is live below your means, and that's the first sentence. Live below your means. I remember back in the days when I got my job, I used to work with CBS Television, no less. And my wife was working for the RCA General Electric at the time. And we said we will save one salary and we'll live on the other salary. And we would buy used cars and everything else. And we would actually live in 2-bedroom, 1-bedroom apartments and all that. Make it a point to save 10% of your salary before taxes into your retirement accounts, and make it as a point to save 10% of your after-tax money into a mutual fund like Vanguard or something like that. If you can do that, of course, people tell me today cost of living has gone up, housing costs have gone up, and everything else. Step one, save. Step two, invest. Step three, become informed consumers of investments. People tell me, oh, gee, I can't take any risk with my money. Let me give you one statistic. Since 1950 till today, just excuse me, I'm going to grab something.
Yeah, sure.
I don't know if you can see this book or not. It's called called the University of Chicago publishes an annual yearbook of financial history since 1926. They are the most authentic information in the world when it comes to security price and all that. Since 1980, interest rates, treasury bills, CDs were 4%, and inflation was 3%. In other words, since the last 40 years, you made 1% before tax on your CDs. Because you didn't want to take any risk. All you did was to go to local bank, put your money in a CD, and you put the money there, and you pay tax on this 1% after no, actually you pay tax on the 4%. And so your real return was negative. So the point is learn to make how investments work, how to make them work for you. Those are the advice I would give to somebody who is in their 30s. I invite my panel, my friends, to also chime in and give their thoughts on this question.
No, Ram, continue. I think you summarized very well. First is save, second is invest. And so in our business in global wealth management, we focus on the second part for our clients, and we've been very successful. And what Ram means by invest is, especially for people in 30s, is we stay heavy on the equities in the equity market, because that's where you will earn maximum return on your savings. Fixed incomes have not delivered that kind of returns, unlikely to deliver. So in your family finances, make it a point that either both of you or one of you should have a reasonable understanding of behavior of capital markets. Don't take too much risk, but investing in, as Ram said, Vanguard type of funds or any other such safer investor vehicle, which is more oriented towards equities. So in 30s, I will suggest even having a 100% equity portfolio is the right thing to do.
I'd just like to add that for those of our audience members whose companies perhaps provide 401k opportunities and matching, really, if I look back at when I was that age, I think to the extent possible, you want to maximize that, contribution towards your 401k and get that employee match, because that's just free money coming towards you. So, try to exert a little discipline there and get that money put aside.
Hey Ram, what are your thoughts now?
Yeah, I agree. Start as early as possible. Today's the day to start. Don't postpone. Even if you have small amount savings, start as early as possible. Get that compounding going.
Thank you very much. So moving to the next question, this is related to home buying. Which one is beneficial, paying 20% down payment versus 5% down payment, and plus spending on mortgage insurance for buying a house? So basically, right, so you need, if you put 20% down, you don't have to pay mortgage insurance, right? Or the question is, if you want to pay down payment 5% and take that money and then invest somewhere and then pay the mortgage insurance. I think that's the context.
This often turns out to be not because people want to pay the mortgage insurance. The housing prices are going up, and the prices. Young people want to buy a home. They may not have enough savings of their own to put 20% down. Many times parents are stepping in and helping the down payments. That's the only way they're able to do it. And the other thing that scares the most is today to me is, since 1980 till 2020, inflation has been on a secular decline in inflation. And in the last 2 years, both the Federal Reserve, as well as, again, no political inclination to what I'm trying to say, somehow they actually are actively promoting inflation. That's what the Federal Reserve did. And now we're looking at inflation. Published inflation is already pushing 4 or 5%. Our checkbook inflation, which is really what you and I pay, housing costs have gone up. At least in Austin, where I am, housing prices have gone up by 50% in the last 12 months. And the same thing happened in Bay Area and other parts of the country and all that. So Also, another thought out of experience is that at least in the Indian community, home is our biggest asset. That's where we live. That's where our lifestyle is and everything else. Buying a home, nothing wrong with it. I assume that you have a stable job and income and everything else. If you ask my question today in 2022, buy the house even with 5% and paying your mortgage insurance, rather than waiting for 2 more, 3 more years and then trying to come up with the same down payment. That's my suggestion.
Provided you don't spend that 15% somewhere else.
Of course.
Yeah, so I think that is the question. Actually, you answered that another question also, which is like, I mean, offshoot of this. I mean, somebody's asking like, is buying a house in the current market aligned with financial independence? I think you answered yes, right. But here, this person, I think, is you have the money 20% down, and still you want to put 5% and then pay insurance and mortgage insurance, and have that remaining 15% invest somewhere else.
No, I would.
So which one is beneficial? That's the.
If you have the money, put the 20% down.
Okay.
Have the money, because what happens is, home is a different type of an asset. If this is something where you come home, you don't have to worry about, oh my God, how am I going to make the payments and this and that and all that. By all means, try to put the 20% down. In reality, 20% itself doesn't do the job. You need the other 4 or 5% to furnish the house and other things and everything else, the closing costs and all that. Certainly, I would encourage people to put the 20% down.
Okay. Since we are touching on this home mortgage, there is another question related to it. Is should I pay extra mortgage payments each year, or leave the?
Today interest rates are extraordinarily low, adjusted for inflation, and so it's a question of what is the interest I'm paying, what is the inflation rate. I'm getting some deduction. Of course, if you're taking standard deduction, you're not getting any mortgage benefit out of that. What we have done historically is, instead of paying 12 mortgage payments a year, make 13. Send one extra payment, or just if you have your mortgage payment at $2,500 or $3,000 a month, let us say, you add another $400 or $500 on the top without pinching your lifestyle too much. What it does is those extra payments actually directly go to your principal, and thus reduce. See, suppose you're 35 years old and you bought a house, you took a 30-year mortgage and all that. Remember, on the top of our conversation, we suggested that you try to pay off your mortgage by the time age 60 comes. Mm-hmm. So I would suggest that don't go overboard and divert all your savings to paying down the mortgage. So I met some people saying, no, I want to pay my mortgage down. It's like, it keeps me up at night. No, wrong. In fact, you have several responsibilities, like funding your children's education, saving something for your retirement. All these things are like, they're all running parallel, not sequential.
Okay, thank you. Now just switching a little bit on estate planning. I see a question, what is probate and how does it impact our finances?
That to answer the question of probate, you have to talk about the will. Mm-hmm. See, if you sell a house, what do? You go to the closing, the attorney says sign here, and then you sign them and everything else, and the closing happens, right? Mm-hmm. But suppose a person passes away and he's the owner of that house, he can't come to the closing anymore, can he? So a will is basically a legal document instructing the county court, surrogate court, to say that if something happens to me, I want my property, my wealth, my money to go to such and such people, because I won't be there to sign. In a plain, simple language, it's a letter to the court to say, if I'm not there, I kick the bucket, please. This is what I want you to do.
Yeah.
So that is that's a probate. A lot of times, the probate process, believe it or not, people make a big deal and all that nonsense. You can just go to the county courthouse, file the will and say, I'm here to probate, and they say, okay, pay some fee and everything else. So if you know what you're doing, probate is not a very big deal. Okay. A lot of times attorneys try to say, no, you should do this living trust and that and everything else. Get hold of a knowledgeable financial advisor before you start doing all these things. But probate is a process by which the decedent's wealth is transferred to the heirs. One thing. There's another probate, another information that you should understand. The will does not cover pension assets. A lot of people write a will and say, done, I've done my will and everything else, I'm good to go. That's not correct, because you have not, if you did not fill your designation beneficiary form or updated it, then the will can't help you. This is a very famous court case. This gentleman joined the New York City police workforce, and at the time he was young, so what he did was to write his parents' names as the beneficiaries for his pension. And years went by, and the wife, family and all this, something happened, this guy died. But he never updated his designation beneficiary form. The wife went to court and said, bloody hell, I'm the wife and I shouldn't be getting these things and all that. He said, well, he never signed the designation of beneficiary form for you. What are you going to do? So just like you're writing a will, remember, a will covers only after-tax money, your home, your investments and everything else, but they do not cover your pension assets. So writing, just like you're writing a will, think that writing designation of beneficiary for your pension plans also is equally important. All right?
Okay. This is another interesting question. How can I earn tax-free income?
The most famous.
Everybody wants tax-free.
Well, again, what it means is that you're buying, see, municipal bonds issued by the state governments and the municipalities in this country are exempt from the federal taxation by Supreme Court decision. Supreme Court said that unlike in India, all the states are sovereign independent republics. They all came together to form a United States of America, but even today, each state in the United States is a sovereign independent entity. One entity cannot tax the income from the other entity. So these are municipal bonds. Now, municipal bonds are very interesting to earn income, but that's more for when you have a large estate. Maybe when you want to generate some income, tax-free for purposes, there is a time and place. But in a young couple's life, financial planning, tax-free municipal bonds is a little bit too early to discuss at this time.
Mm.
I would add that for younger population, having 529 plans for their children,
Excellent.
and as we earlier mentioned, contributing maximum to their 401k, that's a good tax planning strategy than to look for smaller investments in muni bonds.
Exactly.
Maybe Ram, you can educate everyone on 529 plans.
Yeah, we'll come to that. Maybe Prasad has a few more questions, but otherwise we'll go to other questions.
Yeah,
Yes, Prasad.
yeah. Now we can talk about the college expenses 529 plan. I think that's we can do that.
College education has, in the last 40 years, college education has outpaced inflation by a factor of 2 or 3. If inflation was 3-4%, college tuition has gone up by 10% compounded. So today, for a parent, next to buying a home and paying the mortgage, college education funding has become a huge expense. Back when Rama and I started, there were no 529 plans. We actually had to pay the Uncle Sam the income tax and pay after-tax money to send the kids to college. Only in the last 15, 20 years, this 529 plans came, which are one hell of a tax break. And, somebody tried to yank it out, I said, no, we should not have it. And the guy got shooed out of Congress. 529 plans, if you put, anybody can put a 529 plan for the benefit. The parents can do it, uncles can do it, grandparents can do it. You contribute after-tax money into a 529 plan, and it grows. The earlier the better. And then if you pay the tuition directly from the 529 plan to the college, it comes out completely tax-free. So not only are you being able to fund it, grow it, and then use the money to pay the tuition, it's an excellent way to save for children's education. And the other thing is, a lot of people think that, oh, no, I should keep my money in, where's the kid is coming to the college, the money should all be in cash. Not true, because typically 4-year colleges, you can pay the tuition spread out over 4 years period of time. And you could even pay it monthly. I used to do that at University of Chicago like that. So 529 plans are one of our favorite subjects. You must take first down sort of paycheck, put money into 401k plans, which are employer provided retirement plans. You forget that out, leave them alone. Don't touch them until you're 59 and half, 60 or whatever. The next dollars must go to your 529 plans. Start the 529 plan the moment the child is born. If you can own a home, you put in 529 plans, you put in 401k plans, that you made a fantastic beginning to your financial picture.
Okay.
Ron,
Thank
can
you.
I add? I'm just going to throw something
Sure,
out
sure.
there that perhaps our audience might be thinking about. Right now, as we know, the market is looking crazy. It's been at all-time highs. What would you say to a young person in our audience that might be wondering, should I be getting into the market? What's going to happen? What would you advise?
Excellent question, actually. Ram can recount our 1987 stock market crash, 1991, you remember, Ram, all the crashes we went through for 3 times. And so Sripat will tell you this more eloquently. A nation's equity markets follow the GDP growth of their country. The GDP growth in many ways is driven by 2 things, either by population growth or technological innovation. In some countries don't have the population growth, but they have fantastic technological innovations. And so the productivity is driving the nation's GDP. Take a country like Singapore. Singapore doesn't have population, but they have the productivity and they have the innovation. So if you were to follow these things, stock markets are in general produce inflation plus about 5 to 6% annual provided your time horizon is 5 to 10 years. I advise a young person today, first thing is to build a small emergency cash reserve, 3 months worth of your salary, just to, in case something comes along. But the rest of the money, definitely start dollar cost averaging, meaning put in every 15 days, every 1 month, and small amounts of money and start building money. Don't pay attention to the fluctuation of the stock markets. They fly. In fact, young people should be investing the monies in that manner. Why? Because when you're buying regularly, sometimes you pay a little bit more, sometimes you pay a little less, but on average, your average cost will come out to be pretty favorable to you. There is no other investment other than real estate that can keep up with inflation as well as stock market does. So don't worry about fluctuations in the stock market. If you, in fact, in retirement, as Sripat said earlier, 100% of the money should go into equities when you're young. And when you come to your retirement age and all, we can discuss that. But when you're young, our recommendation is that you put 100% of your money into stock markets. Notwithstanding, don't worry about the market price is high. I want to wait, the market come down and all that. You and I cannot time the markets at all. So certainly invest the monies into blue chips. Don't get into speculation. Don't buy into individual situation. If you take an index fund like the Standard & Poor's 500 with the Vanguard, good enough. Close your eyes. What I've seen people do is that in the 40 years, I'm yet to see somebody who has outperformed the S&P 500 in wealth compounding. Even the best of the best, John Neffs of the world, could not do it. If you just simply, it is a passage of the time rather than the timing the markets that builds wealth. You write this down on a postcard, even in front of you in your, when you're doing shaving or you're putting your makeup every day, look at the card. Compound wealth, time compounding. Encourage your children, your family to put. I'll give you a story that just to, for this one. This is a real story. Back in the days when I was in New York City, I have a friend, a single lady. She came to this country as a nurse. She did not even qualify to be a nurse, so she was only working as a licensed practical nurse. So one day I met her like this in some party, and I said, listen, you're single, you don't have any family, you need to build yourself a financial nest egg. What do you want me to do? I said, I tell you what, why don't you do one extra, every month, every 15 days, you do one extra duty and give me that paycheck. She said, what do you do? I get only $70, $80 or something like that. Never mind, give it to me. I put that money in Vanguard S&P 500 starting in 1977, 78. That money grew by 2015, 2016 to something like $400,000. She never looked back. She didn't know anything else. She never looked at the statement. She never looked at anything else. Power of compounding. This is true story. That lady is still there. The Vanguard account is still there.
Yeah, so all of us should not try to become experts of capital market, because that's the mistake we make. And that's what the media tries to entertain us through CNBC and everything else. So dollar cost averaging is one way of riding out volatility. And secondly, we started saying most of our audience here is younger. So look back, two major crashes in the capital markets, 99 and 2000. 2008, had you not sold, money would have still double, tripled from that point onward. So no need to worry about this talk of a crash or a correction and things like that. Just do dollar cost averaging if you are scared of that. Otherwise, just remain 100% invested in equities, mostly large cap, because these companies will survive every world war, every president, every world global political situation. and they will actually come out stronger. Even in COVID situation, look at who are the companies who came out with the solution. It is Pfizer's of the world. So they will turn every problem into an opportunity and will come out a better company. And that's how the PE expansion happens. And that's what we are recommending, saying be 100% in equities, be in large cap, because these are the companies you should be in. And don't worry about these fluctuations and talk about fluctuations, because even in the past two major corrections, had you stayed invested, you would still be very happy invested.
Yeah, thank you. Any other questions from the audience? You can raise your hand. Looks like there are none. Any other closing comments? Mr. Sripat, Ram, Dr. Ram, Ronika?
So my comment is, I mean, maybe Ram and Rama can conclude, is that we should continue this dialogue because this knowledge has to be shared. Global Wealth is one of the few asset management companies in the US, which is run by Indians, manage Indian wealth, and Indian wealth is increasing by leaps and bounds. So we are at the right place at the right time. We were more than happy to share this knowledge, and it's impossible to recreate this. So that's why having this kind of forum where everyone can share their views instead of reinventing the wheel. People like Ram and Rama and many others can share their experience through which the younger population can learn and not repeat the same mistakes.
Okay, one question came in the chat. How do you decide best time to buy a home?
Typically, if you're single and you're very young, you may not want to commit yourself to buying a home. Means you're putting a nail in the ground and saying, I'm going to stay here for some time to come, 4 or 5 years. So young people may or may not be ready to make the commitment, but once you get married and you have a child, generally people, that's the time to also think seriously about buying a home. And the other thing is, I come across a lot of young people, they're not sure, are they going to be in India, are they going to be in the US, or whatever it is. Make a decision and go ahead and do that. Again, this is a personal bias. A lot of times we have become global citizens. Unless we have parents who are going to live in the property in India, buying properties in India and thinking that you're going to manage from this distance is not a practical proposition. So the first home you buy should be the home that you live in. And that's my recommendation. If you can save up money, but I would say 30th birthday is a good benchmark to start.
And also today, in last 2 years, your home has become your office. And
Yes.
you have to think from a point of view that you may end up working there for 6 months in a year, even if COVID situation goes away. So having a home where you can both live and work, and 2, 3 of you, so that's a home has become even more important, because going forward, you will be spending a lot of time there. Work from home culture is spreading.
Right. I mean, my personal opinion is there is no best time. You should always, that should be, if you don't own a house, you should own a house. Just manage that 5% down payment and then buy it. Right? We can always rent it. You can always sell it. You can always manage it. But when we decide to buy, that time, you're not going to get the house for the same price you saw 3 years ago or 5 years ago. So if you have money, have a stable job, yeah, go for it.
One of the things is the road ahead for inflation is pretty bad. We're going to see inflation. Inflation drives housing prices. That's a big phenomenon that we at Rama and myself witnessed in the 70s. where housing prices went through the roof. So now the road ahead is inflation.
Yeah.
My suggestion is try to buy a home as soon as practical.
Correct. Right. Good. Okay, cool. Good. Any other question? Otherwise, Dr. Ram, you can give your closing comments.
Thank you so much. It was wonderful. And of course, I remember all different ebbs and flows in finance. Basically, the one word I would give for financial independence is discipline. That's all. It takes discipline and start early. And so I thank the panel, Ram, Sripat, and Ranika greatly. We will continue this and then we'll go into specific topics in the subsequent webinars. And audience, if you have topics, please feel free to email us for the subsequent seminars.
Yeah.
Thank you so much.
Thank you,
Yeah.
Ram.
Thank you.
Thank
Thank you
you.
so much. There is a
Thank
lot to
you.
cover. So they will be having many seminars, especially on repatriation, so all those things. So we will have, and thank you very much for joining. Thank you and have a nice rest of the weekend. See you. Bye.
Thank you. Bye.
Thank you. Bye-bye.